Welcome back to the deep dive. Today is March 7, 2026, and we are just absolutely thrilled you are joining us.
Yeah, we have a really fascinating journey mapped out for you today.
We really do. So our mission today is to venture into this massive stack of our research and source material regarding the hidden plumbing of global
The
finance.
stuff people don't usually see.
Exactly. We're going to cut right through the retail crypto hype, the Twitter noise, all that endless speculation, and really examine how digital assets are, quietly and profoundly, I should add, being integrated into the traditional banking system.
It really is a hidden world.
Hmm.
When most people think about massive financial revolutions, they picture dramatic press conferences, CEOs shaking hands on a stage, or these massive overnight shifts in the global economy.
Right, the big splashy events.
Yeah, exactly. But the reality of institutional finance is much, much more methodical than that.
Well, I'll give you a hint. The biggest changes in finance aren't happening via flashy announcements on social media. They are happening through highly technical, honestly, incredibly boring sounding software updates inside bank server rooms.
Very boring.
Right, and this is a huge misconception we see all the time. People constantly look for a massive direct partnership announcement. They want to see a headline that says, a digital asset network has officially partnered with Swift, defeated them in battle, and replaced the global banking system.
Which, I mean, that's just a fundamental misunderstanding of how the banking industry actually operates day to day.
Huh.
Banks don't hand code their own Swift integrations from scratch.
They don't.
No, not at all. They don't have teams of engineers sitting in a basement building messaging Rails, one line of code at a time. It's just not how it works.
Okay, let's unpack this, because our research reveals that banks actually rely on third-party messaging gateways and payment hubs. Basically, they buy these massive, complex software packages off the shelf from specialized vendors to handle their global messaging.
And that brings us to a concept in the source material called vendor absorption.
Vendor absorption.
Yeah, it is brilliant in its subtlety, honestly. Ripple hasn't been trying to bypass Swift or defeat it in some grand public battle. Instead, they have successfully integrated at the vendor layer.
Which is the layer that actually matters.
That is the exact layer that actually powers global banking. They've essentially embedded their technology into the existing infrastructure that banks already buy and trust.
So instead of trying to convince a bank to, I don't know, tear out its entire plumbing system and install a brand new one, they just went to the companies that manufacture the pipes.
That is a great way to visualize it. They went straight to the pipe manufacturers. And we actually have the data on this. Our research explicitly lists 7 independent entry points into the global banking system where this vendor absorption has already taken place.
Okay, I want to make sure we highlight those, because for you listening, these are the names quietly running the world's money. Who are these 7 vendors?
We're talking about Finastra, CGI, TAS Group, ACI Worldwide, Eastnets, Volante, and Temenos.
I'm going to guess a lot of people listening have probably never heard most of those names. I mean, I hadn't before we got into the source material.
Most people haven't, but their scale is staggering. These aren't startup companies experimenting in a tech sandbox.
Right.
These 7 vendors provide enterprise-grade ISO 2022 native CBPR plus certified systems that major Tier 1 banks already use every single day to move trillions of dollars.
Okay, time out for a second. Let's make sure we don't lose anyone in the banking alphabet soup. ISO 2022 native and CBPR plus certified. Can we translate that into plain English for those of us who aren't banking engineers?
Absolutely. Think of ISO 2022 as the new universal dictionary for global banks. Historically, a bank in Japan and a bank in the US use slightly different financial languages to describe a payment.
Which causes friction.
Tons of friction. So ISO 2022 standardizes that language so everyone's computers can talk to each other perfectly, carrying much richer data. And CBPR Plus is essentially the strict grammar rulebook for how you use that dictionary over the Swift network.
Got it. So these 7 vendors are selling the software that perfectly speaks this new universal language.
Correct. And because Ripple integrated with these vendors, it's basically like having an app pre-installed on your phone when you buy it.
Oh, I like that.
Right. You didn't have to go to the App Store and download it. The manufacturer already put it there in the factory. It's just sitting on your home screen waiting for you to use it.
I love that analogy. Because of this deep integration, the digital asset XRP is now a selectable switch within the bank's existing plumbing. For example, the source material notes that ACI Worldwide hosts roughly 30% of U.S. Swift traffic.
It's huge.
That is a massive chunk of the American economy. If a bank uses ACI Worldwide or a platform like Finastra, they already have the option to route a payment via a traditional Swift Nostro account.
And just to clarify for the listener real quick, a Nostro account is essentially a pre-funded pool of money a bank keeps in another country just to facilitate trades. It's dead capital sitting there just in case they need it.
Right, thank you for that. So they can use that traditional clunky Nostro account method, or they can literally flip a switch in their existing ACI or Finastra software to use RippleNet and XRP. The capability is already resting on their servers.
What's fascinating here is XRP does not need SWIFT's permission to operate. The banks already possess the switch to choose their settlement rail.
Because it's their software.
Exactly. The infrastructure is completely modular now. SWIFT can carry the initial payment instruction, the message saying Bank A wants to pay Bank B, but the bank itself decides how the actual settlement, the movement of the real value, occurs.
But let me push back on this for a second. Just because I have an app pre-installed on my phone doesn't mean I'm ever going to open it. Banks are famously, notoriously risk-averse. They have literal armies of compliance officers. Why would a Tier 1 bank ever flip that switch to use a digital asset instead of the traditional SWIFT system they've trusted for decades, even if it is clunky?
That is the multi-trillion-dollar question.
Mm-hmm.
And it connects perfectly to our deep dive in Episode 3, where we discussed the licensing mode.
Yes, the licensing mode.
Right, because all the technological capability, all the slick software in the world means absolutely nothing to a major bank if it isn't legally compliant. A compliance officer will shut it down in a heartbeat.
Oh, instantly.
The regulatory foundation is the only thing that allows this vendor absorption to actually be utilized in the real world.
So you're talking about the specific legal permissions.
Yes. We're talking about incredibly difficult to obtain licenses, like the New York Department of Financial Services Trust Company Charter and the UK Financial Conduct Authority's EMI permissions. These are the gold standards of regulatory approval.
The ultimate stamp of approval.
They provide the legal cover that those risk-averse banks require before they will even touch that selectable switch.
It's amazing to think about how much the regulatory landscape has shifted. Looking back from where we sit today in March 2026, the environment is entirely different. For years, the industry was frozen by ambiguity. But we can look back at the March 2025 SEC settlement where Ripple paid a $50 million fine and the December 2025 CFTC pilot program for tokenized collateral as these massive historical turning points.
They really were.
At the time, they seemed like isolated news events, but they provided the exact regulatory clarity that institutions were desperately waiting for.
They were the ultimate green lights. Yeah. The ambiguity was completely gone. And Ripple capitalized on that newly found clarity immediately. If we look closely at the full architecture outlined in our source material, it becomes clear that Ripple isn't just a cross-border payments company anymore.
They didn't just sit on their hands.
No, they methodically went out and acquired a full institutional stack.
Right. Our research shows they basically went on a highly targeted shopping spree to bring all the pieces of the puzzle under one roof. They acquired Hidden Road, which is now rebranded as Ripple Prime. Why did they need them?
Hidden Road gives them prime brokerage and clearing capabilities. It allows massive institutions to trade digital assets with the same sophisticated credit and margin structures they use in traditional equities or foreign exchange.
Okay, then they bought G Treasury. What does that piece do?
G Treasury is a massive, multi-trillion-dollar corporate treasury command center. It is the nerve center for chief financial officers at major corporations. By acquiring them, you are putting your technology directly onto the dashboard that a Fortune 500 CFO looks at every single morning to manage their global cash.
Wow. And finally, they acquired Standard Custody and a company called Rail for virtual accounts and collections. So they basically built an all-in-one dashboard.
Exactly. The reason this matters, the reason they bought these specific puzzle pieces, is cohesion. It allows financial institutions to manage stablecoin settlement using the heavily regulated Ripple USD, or RLUSD, and cross-border liquidity using XRP in one compliant end-to-end environment.
So instead of a corporate treasurer having to juggle 5 different fragmented crypto platforms, one for holding the asset, one for trading it, one for moving it across borders, they just log into one unified system.
Precisely. They want one dashboard that handles custody, liquidity, collateral, and settlement seamlessly. When you combine that cohesive software stack with the licensing boat we just talked about, suddenly flipping that switch in their vendor software doesn't look risky at all.
It looks like a no-brainer.
It looks like the most logical, efficient business decision they could make.
Here's where it gets really interesting. We've spent a lot of time talking about the software layers, the vendors, and the regulatory history. But how does this underlying plumbing affect the actual digital assets themselves? Because the source material points to a very specific event back in late 2025 as a major catalyst, the launch of CFTC-regulated crypto margin deposits by Bitnomial.
If we connect this to the bigger picture, to really understand why that binomial event was so critical, we have to talk about banking capital requirements. Specifically, the global regulatory framework known as Basel III.
And Basel III is essentially the rule book written after the 2008 financial crisis to make sure banks don't over-leverage themselves and collapse, right?
That's a perfect summary. And a key component of Basel III is something called the Net Stable Funding Ratio, or NSFR.
Okay, NSFR.
This specific rule forces banks to hold high-quality liquid assets to cover potential stress events. In plain terms, if a bank has certain liabilities, regulators force them to keep a massive pile of very safe, highly liquid cash or government bonds locked up just in case the market crashes.
Which sounds great for safety, but I imagine it's a nightmare for a bank's profit margins. It's like having $1 million to your name, but it's frozen in a block of ice in your freezer. You can't invest it. You can't loan it out. It's just trapped capital.
It makes holding that trapped, idle capital incredibly expensive for institutions. It drags down their entire balance sheet. Because of Basel III, they desperately need collateral nobility. They need assets that can settle instantly, 2047, to free up their balance sheets and unfreeze that block of ice.
Which brings us to the actual mechanics of how an asset functions in this environment. The source material breaks down a fascinating liquidity equation, and I want to spend some time here so we really grasp it. The equation is price equals transaction value divided by float multiplied by velocity.
It's a fundamental economic equation, but its application to digital assets is deeply misunderstood by the general public. Let's break down the bottom half of that equation first. Float multiplied by velocity. In retail payments like you or I buying a cup of coffee with a digital token, you expect very high velocity.
Right. If I buy a coffee, the barista takes that token, uses it to pay the coffee bean supplier, the supplier uses it to pay the delivery driver, and so on. That same single token might change hands hundreds of times a day. That's high velocity.
Exactly. But institutional finance is a completely different beast. In the institutional world, these assets act as collateral. They aren't bouncing around from wallet to wallet buying coffees. When a massive institution uses a digital asset to secure $1 billion derivatives trade, that asset gets parked, it gets locked up.
So when XRP is adopted as native margin collateral on regulated platforms like Bitnomial, those assets aren't moving anymore. They're sitting idle in clearinghouse pools to prove that the trader has the funds to cover their bet.
Correct. And furthermore, we have to factor in the massive institutional accumulation through ETFs from Wall Street giants like Franklin Templeton and 21 Shares.
Right. The ETFs just soak up supply.
When institutions buy these assets through an ETF, they don't leave them on an exchange. They place them into long-term, deep, cold custody vaults. These are offline servers locked in physical bunkers. Those assets are not moving.
Okay, so let's plug this back into our equation. The float, which is the actual amount of the asset available for active trading on the open market, is actively shrinking because Franklin Templeton and clearinghouses are locking it in vaults.
Yes. The float shrinks due to institutional accumulation.
Yeah.
At the exact same time, the velocity, how often the asset moves, declines significantly because the asset is serving as dormant margin collateral to satisfy those Basel III liquidity buffers we talked about.
So the bottom half of our fraction float times velocity is getting smaller and smaller. But what happens to the top half of the equation, the transaction value? Because if we are talking about routing the global derivatives and repo markets through these vendor gateways, that transaction value is in the trillions of dollars. It is astronomically large.
And that is the crux of the structural mechanics. If the required transaction value is massive and growing, but the available float and the velocity of the asset are both dropping, mathematically, the per-unit capacity of the asset must adjust upward to handle the sheer load of the value moving through the network.
It's pure structural physics at that point. It's like having a massive raging river of water, the transaction value, and forcing it through a pipe where the diameter is getting smaller and smaller, the shrinking float and velocity. To get all that water through the pipe, the pressure or the systemic capacity of the water itself has to increase dramatically.
Precisely. As the asset transitions from a simple retail payment rail into a core foundational market infrastructure asset, its fundamental role changes. To support the massive transaction value required by tokenized institutional markets, while operating with a heavily restricted float and much lower velocity, the systemic capacity of the asset mathematically adjusts. It is not about speculation. It is a functional mathematical requirement of the infrastructure working as intended.
So what does this all mean for you, the listener? Let's bring this all together. The concept of vendor absorption proves that the infrastructure of tomorrow is already here. You don't need to wait for a headline saying, crypto has taken over the world. It's disguised as the boring, everyday vendor software updates of today. The revolution isn't going to be televised. It's already installed quietly in the payment hubs of Finastra, CGI, and ACI worldwide.
It changes the way we should look at financial modernization entirely. We've spent a lot of time today discussing corporate banking, commercial plumbing, and institutional margin collateral. But to leave you with a final thought to mull over our research also details Ripple's ongoing work on a completely different front: sovereign nations.
Right, the central bank digital currencies, or CBDCs.
Exactly. We are seeing private CBDC ledgers being actively developed and deployed with nations like Bhutan, Palau, Montenegro, and the Hong Kong Monetary Authority. These are sovereign nations building their digital fiat on private-controlled versions of this exact same ledger technology.
Which brings up a wild scenario. So consider this. If these sovereign nations begin issuing wholesale digital fiat, actual government-backed digital money, and those CBDCs plug right into these exact same 7 vendor gateways we just talked about, gateways like Volante and Temenos.
Right alongside digital assets like XRP and the RLUSD stablecoin.
Right. If they're all moving on the exact same rails, through the exact same vendor software, does the distinction between traditional fiat and digital assets completely dissolve at the institutional level?
It's a profound question. Will we soon reach a point where banks don't even know or care what underlying asset is moving? Whether it's a tokenized euro, a stablecoin, or a digital asset, as long as the rails are instant, mathematically secure, and legally compliant, the distinction might cease to exist entirely.
That is an incredible thought to end on. When the plumbing is universally compatible, the water is just water, regardless of what label you put on it. This podcast is for education only. Nothing here is financial, legal, or tax advice. We may discuss assets, but nothing is a recommendation to buy or sell. Do your own research and talk to a licensed professional.